Today's tutorial will be about insurance products. Now, for both SP7 and SP8, the first few chapters are exactly the same, so this tutorial will be applicable for both modules. Now, the first thing that I'll go into is what does it mean for a risk to be insurable? There are three main criteria for a risk to be insurable. The first is from the perspective of the policyholder. They must have an interest in the risk so that to ensure that they're not gambling on someone else's future. The second, from the point of view from the insurance company, the risk must be of a reasonably quantifiable nature so that they can estimate future claim amounts. And finally, the amount payable for a claim must be roughly comparable to the loss that is incurred to the policyholder. Now, there are additional criteria which are ideal or desirable, and this is put into an acronym known as MUDPIES. The first being moral hazard should be eliminated as much as possible. What is a moral hazard? Now, moral hazards are defined as behaving less carefully than they would have if they were fully exposed to the circumstance of their actions. For example, if I took out home insurance, which covers theft of my house, and I purposely, let's say, left the front door open, this would be an example of moral hazard. Now, the second desirable condition is that there should be an ultimate limit on the liability that is taken by the insurance company. There should be data available for the insurer to estimate both the probability and the size of the risk. The probability of the claim event should be relatively small. Each risk event should be independent. And finally, similar risks should be pooled together to reduce variance and achieve more certainty for the insurance company. Now that we looked at both the main criteria and the desirable criteria, we'll now look at a past paper question to apply this. So the first part asks us to list the criteria that risk event should satisfy to be insurable. Now what we'll do is we'll simply state the criteria in the previous slide. The second part of the question asks to discuss the extent to which each of the proposals satisfies the criteria. Now, because it's a discuss question, there's scope in the answer to have different points of view. For part 2, let's look at proposal A to start off with and see which of the criteria proposal A either satisfies or doesn't satisfy. So firstly, since the school requires insurance cover, they are interested in the risk, so that criteria is satisfied because they will have to pay any future claims, any future prize money. Secondly, the risk is easily quantified because we have dice and we can calculate the probability of each event happening. Thirdly, each dice roll is in fact independent, and the probability of getting 6 sixes is very small, so we have achieved those criteria. However, there is no upper limit of the liability to the insurer, as we might have many different people rolling 6 sixes to win the prize. And finally, the head teacher is confident there will be at least 100 competitors, but is 100 competitors large enough to reduce the variance and achieve more certainty for the insurance company? So we've looked at proposal A, now we'll look at proposal B. The policyholder definitely does have interest in the risk, since it is to do with their multiple bills. The risk is definitely quantifiable, since it looks at the excess over the inflation rate. The amount payable for the claims is related to the policyholder's monthly bills. The probability of any price increases exceeding the RPI isn't low. That might be argued to say it's quite high. Additionally, as well as that, any bills between policyholders may have some correlation, meaning that risk events might not be dependent. And finally, there might be moral hazard in the sense that policyholders might overconsume utilities to make sure that their monthly bills are increasing from month to month, which exceeds the current monthly rate of retail price inflation, so that they can get the insurance payouts. Now, for part 3, we are being asked to suggest amendments to each proposal. So in total, we're looking at 8 amendments, 4 from proposal A, 4 from proposal B. Firstly, for proposal A, we can reduce the entrance fee and the prize to £1, which is the entrance fee, and the prize to £2,500 to get more competitive in. this would eliminate this point here of 100 competitors by having more competitors enter the game. Another point is that we can increase the number of dice from 6 to 8 or 10 to reduce the probability of the claim even more. We can limit the number of winners, or if there are the same number of winners, we can share the prize. For proposal B, we can limit the maximum payout per policyholder. We can exclude certain companies who we've seen in the past constantly increase unit rates of utilities. We can change the cover from RPI to an alternative measure to reduce the probability of a claim even more. And finally, we can limit the consumption of utility up to a certain amount. Now that we've done this question, we're going to look at moral hazard more closely using another part of the question. This question talks about moral hazard. Now, the first part is to define the term moral hazard. We've defined the term moral hazard as behaving less carefully than you would have if you were fully exposed to the circumstances of your actions. That's a simple mark. Now, the second part of the question is to write two distinct examples of how moral hazard might arise in commercial lines contract. We've given two examples. The first one being not having sufficient fire safety equipment in a commercial office, and firms not vetting staff for background checks just because their insurance covers this. The final part of the question asks us to outline ways that an insurance company could reduce the risk of moral hazard. And we're looking for 4 different points here. They could implement policy exclusions. They could increase the policy excess to make the policyholder retain a share of the risk and to increase their interest in the risk. They could implement stricter claims handling, and they could introduce no claims discounts to discourage claims. Now we're going to look at the policy document and exclusions in a bit more detail. Once the policyholder has purchased the insurance, they will be issued with a policy document. The policy document sets out the terms and conditions for which an insurer is liable to pay claims to a policyholder. And typically, this has to be very tightly worded to cover all circumstances. The items that vary between the policyholders are included in the policy schedule, and certain items that are included in a policy schedule might be any particular vehicles or property or persons covered under the policy, any specific excesses or limits, any exclusions that apply, and any premiums paid and how they're paid. What are exclusions? Exclusions are clauses in a policy that limit the circumstance in which insurers pay claims to policyholders. Now, why is this needed? There are multiple reasons for why this is needed. Firstly, the policyholder might be at an advantage by having more information about the likelihood of a claim. The claim event might be difficult to verify or is in control of the policyholder. Any loss that occurs might be just because of natural events or depreciation. The probability of a claim might be very high, in which case the insurer might exclude it from the policy. The risk can't be easily estimated. The risk event might be covered by a third party, government for example. Exclusions might be implemented to limit the target market or to reduce the premium for competitive reasons. Now what we'll do is we'll look at a past paper questions on applying exclusions. In this particular example, we're being asked to define an exclusion firstly. An exclusion is a clause in a policy which limits the circumstance in which an insurer pays claims to a policyholder. In the second part, we're being asked to first of all explain why a general insurance company might use exclusions, and then to give examples and apply this to household insurance. So we're looking at 6 points why a general insurance company might use exclusions and 6 examples. Now, the reasons come from the previous slide. In terms of the examples, for the first one, we have the policyholder has prior knowledge of existing subsidence of the house. Now, subsidence means that the ground underneath the house sinks gradually over time. The claim event might be difficult to verify, and for example, this might be a loss of cash. The claim event might be in control of the policyholder. For example, the policyholder might have left doors unlocked. Any losses might have occurred due to depreciation, so there might have been wear and tear of clothes or furniture. The probability of a claim might be very high, where the house might be on the edge of a cliff. The risk can't be reasonably estimated, where there might be risks of war for the house, in which case the insurer might not be able to find out or estimate the likelihood of or the size of the claim. The risk might be covered by a third party like the government. For example, under household insurance, terrorism might be covered. Exclusions might be used to limit the target market to only allow certain natural weather perils. And finally, exclusions might be included to reduce the premium for competitive reasons, and they might exclude certain additional perils. Now we're going to look at the different types of insurance products. The first type of insurance product that we look at is liability cover. This is where the insurance company reimburses an individual or a corporation where the insured is legally liable to pay compensation to a third party. And examples of liability products include employer's liability, motor third-party liability, public and product liability, environmental liability, and cyber insurance. The next type of insurance is property damage, and this reimburses the individual or the corporation for any loss of or damage to the policyholder's own property. And examples include the typical house, home insurance, or commercial buildings insurance, or vehicles, car insurance, bus insurance, taxi insurance, and finally we have engineering, machinery, and crop insurance. The next type of insurance product that we'll look at is financial loss, which reimburses the individual or the corporation against any financial losses from certain situations. So we have, for example, fidelity guarantee, which covers fraud or embezzlement of employees, credit insurance, payment protection insurance, business interruption insurance, and legal expenses insurance. Finally, we have fixed benefits, where the benefits are usually specified, fixed amounts, payable on certain situations occurring. And the two examples of this are personal accident insurance, covering any loss of limbs, or any disability that occurs through accident or injury. Now, when we look at insurance products, we look at the typical features. So that's what we're going to look at right now. The first typical feature of an insurance product that we should understand is the benefits that the policyholder gets. This typically varies between products, and the intention is to indemnify the insured or to provide the insured with money to cover their financial loss. Now, any benefits can also come in the form of benefits in kind, so non-cash benefits, like a courtesy car. The next feature of an insurance product is insured perils, and this is any type of event that might cause a loss. Now, in a policy document, this is virtually impossible to list all the perils, so perils might vary from product to product. The third feature is the basis of the cover. Now, policies for insurance are written either on a losses occurring basis or a claims made basis. The losses occurring basis is where a policy provides coverage for any loss that occurs in a defined period, no matter when they are reported. For example, if an individual has an annual policy in 2024 under the losses occurring basis and has a car accident on 27th of December 2024, but waits until the new year to report the claim, they are still covered because the accident occurred in 2024. And the second basis that is used is claims made. The claims made basis covers all claims reported to an insurer within the policy period, no matter when they occur. Now, in the same example, if that same individual has another annual policy with a different insurer under this basis for 2025 and waits until January 2025 to report the claim, the individual can report the claim to this particular insurer. Now, for the most part, losses occurring basis seems more sensible because it's not affected by when the policyholder chooses to report the claim. The next feature that we'll look at is the exposure measure. Now, the exposure measure is the basic unit used by the insurer to measure the amount of risk insured that is usually over a given period. This is essentially saying that the amount of risk in a policy depends on the probability of the claim and the expected cost per claim. Now, insurers determine these two things by looking at measures of exposure. or showing how much risk there is. Now, there is a criteria for a good and reasonable exposure measure, and that comes in the form of another acronym, VENOM-ADA, or VENOM-ADA. The first being that the exposure measure should be verifiable, it should be easy to obtain, it should be hard to manipulate the exposure measure, it should be objective and not subject to opinion, it should be measurable, should be acceptable to the market and to the policyholder, and should accurately define the risk. For example, for household insurance, a suitable exposure measure should be the number of bedrooms per unit policy year, and for business interruption, a suitable exposure measure should be annual turnover or profit. Another feature, or another two features of insurance products are risk factors and rating factors. Now, risk factors are any simple factors which affects the amount of risk in a policy. Now, these might be simple factors that might not be applicable or easily measured, whereas rating factors is any factor that affects the price or the premium of a policy. These could be objectively measurable risk factors or any other factor that could be used as a substitute for the risk. Now, in the EU, insurance companies can't use a person's gender to calculate insurance premiums. And typical rating factors that are useful and apply to every single insurance product is the excess or deductible on a policy, the duration or the period of cover, claims history of a policyholder, any limits or sums insured, any exclusions that the insurance company applies, the location of the policy, and any cover type, whether it's basic or comprehensive cover. Now what we're going to do is we're going to look at applying risk and rating factors into a hypothetical question. So for this question on the left-hand side, a general insurance company is proposing to sell a new product through a bank. The product would be sold to the bank's customers when they take out a loan, and the product will repay the loan in full if the customer were to be made unemployed. We've been asked to outline risk factors that would determine the expected cost of claims. So we're looking for around 6 risk factors. The risk factors that we would typically write down, because it's related to a bank loan and it relates to repaying the loan in full if the customer were to be made unemployed, the risk factors that would typically affect the amount of risk in the policy would be related to occupation, the unemployment history of the individual, whether the individual has any qualifications or experience, also the size of the loan and the term of the loan, the state of the economy where they live, and so this would affect how easy they would be able to repay the loan, and their age and their gender. Recall that the rating factors aren't able to use the gender, but we can still use gender as part of the risk factors. Now, for the question on the right, we're being asked to suggest rating factors that could be used for a travel insurance product. Again, we're looking at around 6 rating factors. These rating factors would be the length of travel, how many people are covered under the policy, the destination that we're traveling to, any past claims history, any limits or excesses or deductibles, and whether the product covers a single trip or is it an annual policy. Now, the final feature that we consider when talking about insurance products is the characteristics of claims that might occur. And these characteristics come in form of another acronym. This is Kraft, Cramps, Vens, and Drills. So, going through the acronym, with catastrophes, is the product prone to natural catastrophe losses? The second being reporting delays. This is the delay between a loss happening and the policyholder reporting it to the insurer. The third being the severity of the claim, or the amount of the claim. How big or small could the claims be? The frequency being how often could claims be made. Trends within the insurance product. Do claims correlate with the economic recession or any social trends? Is there potential for claims to be in different currencies? Is it common for reinsurance to be purchased to mitigate against this product? Is there a possibility for many claims arising from a single event or come from the same geographic region? Moral hazard, which we've looked at before. Is there a possibility for moral hazard to occur? Partial payments. Now, instead of a lump sum that is given after a claim, a series of regular payments are given to people after an accident and after court award. Is there potential for partial payments to be made? Settlement delays, which is the delay between the claim being reported and the payment being made to the policyholder. Is this short? Is this long? And what's the reason behind it? How volatile is the claims experience from year to year? Does it depend on bad weather, economic recession? What is the event delay? Well, the event delay is the delay between policyholder realizing there's been a loss, and this might be because they might have been on holiday whilst there was a burglary. Nil claims, where you look at is there potential for fraudulent claims or policyholders making claims which are below their excesses. How is a claim defined? Is there a certain time period in which claims must be made between? Okay. Seasonality. Is there a specific season of more claims than usual? What does the distribution of the claims look like? Is it more common to have larger or smaller claims? Is there potential for claims to be reopened in the future because another loss has emerged? What types of inflation could affect the size of the claim? We have wage inflation, we have court award inflation, we have legal cost inflation, and we have medical cost inflation. Now, latent claims refer to any perils that are hidden and are not felt for some time after the exposure. For example, policyholders might have exposure to asbestos in a factory or in a big warehouse. Is there potential for large losses? And what are the typical size of these large losses? And lastly, this idea of salvage or subrogation. Now, this is best explained with an example. Let's say I'm involved in a car accident and my car is written off. Under my insurance policy, I will receive money from my insurance company to reimburse me for the loss of asset. Now, what happens to the car and the responsibility of it? Now, subrogation refers to the legal process of my insurance company directly recouping any losses from another party and keeping it to themselves. Salvage is any money that's recuperated from the car part or the scrap. Now that we've looked at the claim characteristics and this acronym, what we'll do now is to apply these claim characteristics to a past paper question. In this particular question, we're being asked to describe the likely claim characteristics of pet insurance. Now, we are looking for 6 different points. So, firstly, the claim frequency would be higher than personal accident insurance, for example. Secondly, claim amounts would relate to injuries or perhaps injection for pets, and this would likely be more frequent than home insurance. The event delay, which, if you recall, is the delay between the loss occurring and the policyholder realizing it. This would be quite short, as you would expect pets to give signs of injury to the owner. Reporting delays, which is the delay between the policyholder observing the loss and notifying the insurer. This would generally be very short, since some treatments might require authorization by the insurers first. Settlement delays, which is the delay between the insurer being notified and the settlement being paid to the insurance policyholder. That would be quite short. It can be longer if any event information needs to be verified by the vet. Any large claims could be possible if a liability claim arises due to a dog bite, for example. And there could be an epidemic in the area, which could lead to an accumulation of claims between pets. And finally, seasonality might be present, since pets might get illnesses during the winter. So we've looked at the features of insurance products, and we've looked at types of insurance products. And what we'll do is we'll look at all of the insurance products in more detail using the particular features. So first of all, we look at liability and all of the different types of liability products along in each row, and across each column we look at all of the features of these underlying products. So for example, the claim characteristics of typical liability policies would be that latent claims are possible since the loss is not evident until years later, so there might be long reporting delays. There are possible settlement delays if any personal injury occurs because litigation might be involved. There may be possibilities for partial payments for motor liability claims. In terms of claims frequency, motor liability might be more frequent than other liability policies, and in terms of claim sizes, these can range from extremely small to extremely large individual claims, taking many years to settle. In terms of property damage, we have the different types of property damage policies, and we can see the features of each of these policies or products. Now you can see that the property damage policies are likely to be written on a losses occurring basis, and that some of the claim characteristics for residential buildings and commercial buildings are that there are a risk of catastrophes, the settlements are usually large single payments, and notification delays are usually quite short. Moving on to financial loss products, we have fidelity guarantee, we have credit insurance, we have business interruption cover, which are the main ones, and you can see that most for all of these insurance products under financial loss, they're likely to be written on a losses occurring basis. Finally, we have fixed benefits. And for fixed benefits would include personal accident cover, and this occurs with a losses occurring basis. And for the claim characteristics for fixed benefits, they are usually reported quickly, but there might be a delay if on accidental death the dependents of the policyholder don't know if the policyholder exists, if the policy exists. Settlements are often quick, but might be delayed if a condition needs to stabilize. Frequency, the claim frequency, is stable, but sizes can be large, and 6 figures are quite typical for a claim size. So that concludes the video tutorial on insurance products. The next tutorial will cover reinsurance products.